Welcome back, everybody. Today we're doing a deep dive into this whole AI-driven stock market surge. Yeah, it's kind of crazy what's going on right now.
It really is.
We've got excerpts from a video that kind of lays out some different viewpoints, like are we in a bubble? Is this all hype?
Mm.
And then also looking at some investor strategies just to make sense of, what's really going on and what it means for, potential investment decisions if you're thinking of, dipping your toe in the water.
Exactly.
And I think the craziest stat that we saw was that I think they call them like the Magnificent Seven, the big tech giants. They have a combined market cap. Get this, over $17 trillion.
Wow.
That's like the entire GDP of China.
That's incredible. Yeah, that's a great place to start. I mean, it's pretty mind-boggling to think about. And, while the S&P 500 is hitting record highs, partially fueled by this, AI frenzy that's going on, there's definitely split in the investment world about whether this is really sustainable. Is this something that we can expect to continue, or is this hype that's eventually gonna,
Right.
fade away?
So who's sounding the alarm bells then?
Well, one person who's pretty skeptical about AI as a long-term profit machine is Terry Smith. You might know him as the British Buffett.
Okay.
And his big concern is whether people are actually willing to pay enough for AI services to justify these, sky-high valuations that we're seeing.
Okay.
So, we've got chatbots, we've got code generators, AI-created content, which is all really cool.
Yeah.
But is it bringing in the kind of money that warrants, these massive valuations?
Yeah. That's a really good point. It makes me think of, like the dot-com bubble, where there was obviously a lot of potential with the internet, but a lot of companies really failed to translate that into, actual profits.
Right.
Are we seeing something similar here with AI?
Yeah, I mean, it's certainly possible. And, Smith actually points out that some of the biggest users of AI, like companies like Microsoft and Amazon, they often end up developing their own solutions in-house. So if you're a smaller company providing AI services, what happens when your big clients no longer need you?
Right.
Your stock price could plummet even if the broader market is still doing well. So that's why it's so important to, really look beyond the overall market trends and really analyze individual companies, especially in, such a fast-moving field like AI.
So it's not enough to just ride the AI wave. You really have to be selective about which companies you're betting on.
Yeah, exactly. And that brings us to another key question, which is, where's AI's killer app? Like, what is that one application that's going to, really generate tons of revenue? If you think back to the dot-com era, it was things like search engines, e-commerce, social media. Like, these things really fundamentally change the way we live and work.
Right.
We haven't really seen that yet with AI.
Yeah. It feels like a lot of it is more like incremental improvements rather than, these big breakthroughs.
Yeah. And that's why investors like Terry Smith are, urging caution, because there's a risk that the hype surrounding AI might be outpacing the reality of what it can actually do right now. Now, don't get me wrong, AI has incredible potential, but we need to be realistic about, where it is right now and where it might be going.
I remember reading somewhere that people were joking that AI stands for artificial imagination instead of artificial intelligence.
Oh, that's funny.
Yeah.
Because there's some truth to that. Like, it's incredibly good at, generating things, text, images, code, but true comprehension, like the ability to, understand the deeper meaning and implications of what it's creating, that's still where AI falls short.
And that's a crucial distinction, I think, for people to understand. Because if we're overestimating what AI can do, we're probably overestimating its impact on the stock market. So I guess the question becomes, if AI isn't this like revolutionary force that some are making it out to be, are those, sky-high valuations really justified?
Right. That's the billion-dollar question. And I think one of the best clues we have is to look at what the most successful investors are doing. So, for example, let's look at Warren Buffett. He's currently sitting on a mountain of cash. Almost 30% of his portfolio is in cash, which is unusual for him, especially during a booming market.
Okay, now for someone like me who, hasn't spent their life studying Warren Buffett, what does that tell us?
Well, Buffett is a value investor. He buys when he believes something is undervalued. So his current position suggests that he's not seeing a lot of value in the market right now. He's being cautious, which could signal that, he's not convinced
Right.
that these valuations are sustainable.
So does that mean that we should all be running for the hills?
Not necessarily. It's about understanding the nuances of the market and making informed decisions. Blindly following the market index is never a good strategy. especially a sector as dynamic as AI. We need to be, more discerning, focus on individual stocks, and really understand their true value.
So how do we do that? How can we avoid buying high and selling lows, even if it's, fundamentally a strong company?
Well, one of the first things you need to understand is market capitalization, or market cap, as it's often called. And this represents the total value of a company's outstanding shares. So a large market cap, like we're seeing with the tech giants, can indicate strong investor confidence. But it doesn't necessarily guarantee future growth.
All right, so market cap is important, but it's not the only factor. What else should we be considering?
Well, there are various valuation techniques that you can use. You've
Yep.
probably heard of things like price to earnings ratios and growth projections. And these are tools that can help determine if a stock is overvalued or undervalued. But, you need to understand how to use them effectively.
For someone like me who's, more of a beginner investor, where do I even begin with all of this?
The key is to start with the basics and gradually build your knowledge. And there are tons of resources available, like online and even some great courses that break down these concepts, in a way that's easy to understand.
Yeah,
The video you shared actually mentioned a few. We can definitely link those in the show notes for you.
perfect. Yeah, I'm sure our listeners would appreciate that. But before we get too deep into the technical stuff, I want to go back to something you mentioned earlier, those technical bottlenecks and staff departures that are happening at some leading AI companies. What's the story there?
Yeah, well, it's not uncommon, for companies in these like fast-growing industries
Hmm.
to experience some growing pains as the demand for AI solutions skyrockets. These companies are racing to scale up their operations and attract top talent. But there have been some reports of, challenges in keeping up with this rapid pace of innovation, and that's led to some, high-profile departures.
So is that a sign that the AI bubble's about to burst?
Not necessarily. I think it's more like a yellow flag, something to watch closely. It suggests that the reality of AI development might be more complex and challenging than the hype often suggests.
Okay, so how do we as investors separate the hype from the reality? Are there any red flags we should be looking out for?
Absolutely. I think one thing to be wary of is companies that overpromise and underdeliver. If a company is making these grandiose claims about its AI capabilities, but they don't have a solid track record of, actually delivering on those promises, that's a cause for concern.
So it's not just about the technology itself, it's about the company's ability to execute and bring those solutions to market.
Exactly. Look at their financials, look at their revenue streams, their customer base. Are they actually generating profits from their AI products or services? Or are they still, in the early stages of development and just burning through cash?
Right.
These are all crucial factors to consider.
It sounds like we need to be pretty savvy investors to navigate this whole AI landscape.
Well, you don't have to be, a Wall Street guru or anything, but you do need to be informed and do your due diligence. Remember, investing in individual stocks always carries a certain level of risk, so you want to make sure you understand those risks and make sure they align with, your overall investment goals and your risk tolerance.
And speaking of risk, let's talk about timing for a second.
Yeah.
The video mentioned the importance of understanding these technical factors and market sentiment to avoid buying high and selling low. I, I have to admit, those concepts always seemed a little bit mysterious to me.
Yeah, I can understand that. It's easy to get lost in all the technical jargon. But essentially, technical analysis involves, studying price charts, trading volume of their market indicators to kind of identify trends and potential buying or selling opportunities.
So we're talking about those like complicated looking charts with all the lines and squiggles.
Those are definitely part of it, but it's not just about the charts themselves. It's about understanding the psychology behind those charts, the forces of supply and demand that are driving those price movements. So technical analysis can be a useful tool, but it's important to remember that it's not a crystal ball. It can't predict the future with certainty.
Right, because the market is influenced by so many factors,
Mm,
including things that are like impossible to predict. Like what if a major political event happens or a new technology emerges that,
mm,
totally disrupts the AI landscape?
exactly. Those are the kinds of wildcard events that can, throw even the most sophisticated technical analysis off track. That's why it's so crucial to combine, technical analysis with a broader understanding of the market. Things like, economic trends, industry developments, geopolitical events.
It's like putting together a giant puzzle. You need all the pieces to see the full picture.
That's a great analogy. And that brings us to market sentiment, which is another important piece of the puzzle. And this refers to the overall, mood or outlook of investors towards the market or a particular stock. Is it bullish, meaning optimistic? or bearish meaning pessimistic.
So if like everyone is super excited about AI and just pouring money into AI stocks, that would
Yeah.
be considered like bullish sentiment.
Exactly. And while that bullish sentiment can, drive prices higher, it can also create a bubble that eventually bursts. On the other hand, if investors are fearful or uncertain, that can lead to bearish sentiment, which can drive prices down even for fundamentally strong companies.
Okay, so it sounds like understanding market sentiment can help us avoid getting caught up in those like extreme highs and lows.
Exactly. It's about recognizing when the market might be overreacting, either positively or negatively, and making, more rational investment decisions based on your own analysis and your risk tolerance.
This is all starting to make a lot more sense now. I'm still a little bit intimidated by those valuation techniques, though. You mentioned things like price to earnings ratios and growth projections. Can you break those down for us in a way that doesn't require a PhD in finance?
Absolutely. Let's start with the price to earnings ratio, or PE ratio, as it's commonly known. This ratio basically tells us how much investors are willing to pay for each dollar a company's earnings.
Okay.
So a high PE ratio could mean that investors are really optimistic about the company's future growth and are willing to pay a premium for that. But it can also be a sign that a stock is overvalued.
So how do we know if a PE ratio is high or not? Is there like a magic number we should be looking for?
Unfortunately, there's no one-size-fits-all answer. It really depends on the industry, the company's growth stage, and, the overall market conditions. For example, a rapidly growing tech company might have a much higher PE ratio than, say, a more established company in a mature industry.
So we need to compare apples to apples, essentially.
Exactly. It's important to look at the PE ratios of similar companies within the same industry to get a sense of what's considered normal or reasonable. And remember, a high PE ratio isn't necessarily a bad thing. It could indicate strong growth potential, but it's also a sign that investors have high expectations. So the company needs to deliver on those expectations to justify its valuation.
Right, they got to prove themselves.
Exactly.
Okay, that makes sense. Now, what about those growth projections? How are those calculated and how reliable are they?
So growth projections are basically estimates of how much a company's earnings are expected to grow in the future. And analysts consider a variety of factors when they develop these projections. Things like revenue trends, market share, industry forecasts, and even the company's own guidance about, their future performance.
So it's like a combination of hard data and educated guesswork.
Pretty much. And it's important to remember that, these are just projections. They're not guarantees. Sometimes companies exceed expectations and sometimes they fall short. There are always unforeseen circumstances that can impact a company's growth.
Right. Like, what if a new competitor emerges? Or a key product launch totally flops?
Exactly. Those are the kinds of risks that investors need to, factor in. Growth projections can be a useful tool. But it's important to view them with a healthy dose of skepticism and, consider a range of possible outcomes.
It feels like there's a lot to juggle when it comes to evaluating these AI companies. We've got market cap PE ratios, growth projections, technical analysis, market sentiment. It's kind of overwhelming.
Yeah, I can definitely feel that way, especially in a field as, complex and rapidly evolving as AI. But remember, you don't need to be an expert in all of these areas to make informed investment decisions. Start with the basics. Focus on, understanding the key concepts and gradually build your knowledge from there.
And take advantage of those resources that you mentioned earlier, those courses and online tools that can, help break down some of these, complex ideas.
Absolutely. The more you learn, the more confident you'll become
Yeah.
in your ability to, navigate this exciting but often confusing world of AI investing.
So as we wrap up this deep dive,
Uh-huh.
what are some key takeaways our listeners should keep in mind?
Well, I think the main thing is that the AI-driven stock market surge is definitely exciting, but it's not without its risks. Don't get swept up in the hype. Do your research, understand the fundamentals of the companies you're considering, and be realistic about AI's current capabilities and its limitations.
And remember, it's not enough to just ride the wave. We need to be selective focus on individual companies and make sure that their valuations are justified. Oh, and don't forget Terry Smith's warning. Those big tech companies might end up building their own AI solutions, which could leave a lot of these smaller suppliers in the dust.
That's an excellent point. It all comes back to doing your due diligence
Yeah.
and really understanding that competitive landscape.
So if AI really is poised to revolutionize everything, which industries or companies do you think will benefit the most in the long run?
That's the million-dollar question. I think it's important to remember that it's not just about the companies that are developing AI. It's about the companies that can effectively integrate AI into their existing operations to create truly game-changing products and services. So think about industries like healthcare, finance, transportation, manufacturing, education. Virtually every industry has the potential to be transformed by AI.
So the possibilities are pretty much endless.
And that's what makes this such an exciting time to be an investor. The future is being written right now, and we have the opportunity to be a part of it.
I love that. Well, thanks for sharing your insights with us. This has been a really enlightening deep dive.
My pleasure.
And to all our listeners out there, stay curious, stay informed, and stay ahead of the curve. We'll catch you on our next deep dive.